Runtime, till to 8 o'clock. The investors making the least. Money check their portfolios the most. Not sometimes. Always. Think about the last 5 times you opened your brokerage app. How much did you actually gain? Here's what happened yesterday. CRM rallied 18%. CRWD surged over 17%. NVDA climbed 8% in a single session, while Bitcoin pushed past 80,000. The Nasdaq jumped 1.3%. Your phone buzzed with notifications. Your group chat exploded. Everyone was talking about what they caught, what they missed, what they're jumping into next. And somewhere in your chest, you felt it. That tightness. That voice asking, what if I'm on the sidelines while everyone else wins? That's not market analysis. That's FOMO. And it's the most expensive feeling in investing. Epictetus taught his students a principle that applies perfectly to modern markets. Wealth consists not in having great possessions, but in having few wants. Most investors read that and think he's talking about money. He's not. He's talking about the wanting itself. Every time you see a stock surge without you, every time you watch Bitcoin climb while you're sitting in cash, every time someone brags about their gains, you're not responding to opportunity. You're responding to want. To the fear that everyone else knows something you don't. That you're being left behind while the train leaves the station. And that feeling, that urgency to act, to chase, to catch up, is costing you more than any market correction ever could. Because here's what Epictetus understood that modern investors miss. The market doesn't care about your FOMO. It never has. The stocks that ripped higher yesterday don't know you exist. They don't reward urgency. They punish it. Every study on retail investor behavior shows the same pattern. The more frequently investors trade, the worse they perform. The faster they chase momentum, the more they lose. Not because the market is rigged, because FOMO makes you buy high and rationalize it as conviction. You think the problem is that you're missing opportunities. Epictetus knew the problem is that you believe missing something is actually a problem. The Stoic investor doesn't avoid FOMO by ignoring the market. They avoid it by understanding what they actually control. You don't control whether NVDA runs 8% today. You don't control whether your neighbor doubled his money on some penny stock. You don't control the group chat, the headlines, the notifications. You control one thing: your response. And most investors surrender that control the moment they feel left behind. Marcus Stone has seen this pattern for 30 years. Not in others. In himself. It was late 1999, and the dot-com bubble was in full euphoria. Every morning brought new stories about overnight millionaires, 20-year-olds retiring, secretaries, outperforming fund managers by buying anything with .com in the name. Marcus was disciplined. He had his portfolio. Diversified, balanced, boring. And for 6 months it did nothing, while everything around him exploded. His younger colleague, Alex Rivera, was making more in a week than Marcus made in a quarter. Not through research, not through discipline, through pure momentum chasing. Alex would walk into the office every morning and casually drop his daily gains. 4,000 on some biotech nobody had heard of. 8,000 on an internet stock that didn't even have revenue yet. Every conversation, every lunch, every phone call was about who caught what and who missed what. And Marcus sat there with his boring portfolio going nowhere. The pressure wasn't just external. It was internal. Every night, Marcus would go home and run the numbers. If he'd just put 10% into the stocks Alex was playing, he'd have doubled that capital. If he'd reallocated his tech holdings into the high flyers, he'd be up 40% year to date instead of 12%. The math was right there. The opportunity was obvious. Everyone else was winning. What was he missing? March of 2000. The Nasdaq was still climbing. Marcus finally broke. Not with his entire portfolio, he told himself. Just a small position. Just enough to participate. He bought a basket of internet stocks at valuations that didn't matter because, as everyone kept saying, this time was different. Alex congratulated him. "Welcome to the game," he said. 3 weeks later, the market cracked. Not slowly, violently. The stocks Marcus bought for participation dropped 30% in days. Then 50. Then some went to zero. Alex's portfolio, built entirely on momentum, evaporated. He'd been making thousands a week. Now he was watching years of gains disappear in real time. But here's what separated them. Alex averaged down, doubled his positions, convinced the dip was a buying opportunity, because that's what had worked for 18 months. Marcus stopped, not because he timed the bottom, because he recognized what had broken, not the market, his discipline. Epictetus wrote, "No man is free who is not master of himself." Marcus wasn't free. He'd handed control to the group chat, to Alex's daily wins, to the fear of missing out. The moment he bought those stocks, he wasn't investing. He was medicating FOMO, and the market doesn't reward that. It punishes it with precision. Alex kept chasing for another year, convinced he could trade his way back. He never recovered those losses. Marcus took a different lesson. The cost wasn't the money he lost on those internet stocks. The cost was abandoning his process for someone else's scoreboard. Stay with this decision for a second, because it's the one that separates reactive investors from stoic ones. When NVDA jumps 8% or CRM surges to a routine, the reactive investor sees what they missed. The stoic investor sees a test of discipline, not because they're better, because they know the game being played. Every surge creates urgency. Every rally creates FOMO. Every group chat, every headline, every notification is designed to make you feel like you're on the wrong side of opportunity. And the moment you act from that feeling, you've already lost. Not to the market, to yourself. Marcus rebuilt his portfolio on one principle. He would never, again, make a decision to avoid feeling left out. Not because FOMO is irrational, because it's expensive. The investors who win long-term aren't the ones who catch every move. They're the ones who don't need to. They have a process. They stick to it when it's boring. They stick to it when everyone else is winning. They stick to it especially when it feels like they're being left behind. Because Epictetus was right. Wealth isn't having great possessions. It's having few wants. And the wealthiest investors Marcus ever met didn't want to catch every rally. They wanted to avoid every stupid decision. Here's your one action. The next time you see a stock surge without you, the next time your group chat explodes with gains, the next time you feel that tightness in your chest that whispers you're missing out, do this. Write down the stock, the price, and the reason you want in. Then wait 72 hours. Not to time anything, not to see if it drops. To separate impulse from conviction. If the thesis still holds in 3 days, you didn't need FOMO to make the decision. If it doesn't, you just saved yourself from the most expensive feeling in investing. You don't need to catch everything. You need to avoid the decisions you make because everyone else is moving and you're standing still. That's not discipline. That's freedom. If this shifted how you see your own instincts, subscribe. Next time, we take this same principle into a completely different market moment. The Stoics had a word for what separates wealthy investors from the rest. Next video reveals it.